Swayam Prabha. Digital India. Educated India.
Hello. Starting with second lecture now, real estate market structure and participants in the course Real Estate Finance and Investment Strategies. So, in this particular class, we will be discussing the structure of real estate market and also we will be talking about the different participants which are there in real estate market. So, first the learning objectives of this particular lecture. So, first we will aim to achieve 5 critical objectives. We will develop a thorough understanding of the fundamental structures of Indian real estate markets, then focusing on their unique operational characteristics that will be there. Then second, we will identify the key market participants and dissect their specific roles in driving market activity. Then third, we will analyze participant interaction and their impact on market dynamics such as pricing, liquidity and transaction efficiency. Then fourth, we will evaluate the regulatory framework, particularly the transformative role of RERA in shaping market operations. And then finally, we will apply their knowledge to practical investment decision making, equipping you with the tools to translate theoretical insights into real world strategies. So, now we will move to list of the content, basically what we will be covering in this particular class. So, our lecture is organized into 4 comprehensive sections. First, we will explore the market structure and participant framework, examining the ecosystem and the flow of information among players. Second, we will conduct an in-depth analysis of key market participants, including buyers, sellers, intermediaries, financial institutions, regulators and support services. Third, we will delve into market dynamics interactions, we will go into that area. Then we will be covering participant relationships, which will like some basic practical application of that. So, in that we will explore the real world case studies and actionable investment insights. So, basically all that, so that we can ensure that this knowledge is applied effectively. Then moving on, we have market structure. So, in this Indian real estate markets are inherently complex, driven by a web of interdependent participants who interact with a dynamic ecosystem. A defining feature in information asymmetry, where developers often possess superior market knowledge compared to buyers, right. So, one point is that we have this complex participant ecosystem. Second, that we can clearly see that there is a information asymmetry. Some are more informed in comparison to others, especially people who are regularly in this business. They are constantly updated with what is happening, and as it is a very micro managed, micro focused industry, where regular rules, regulations which are there on ground impact this business a lot. So, that is why information becomes a very important differentiator, and unlike equities where there is much more transparent mechanism and more information available, in real estate there is a clear difference between well informed developer or people who are regular in this business in comparison to a retail investors. Then there is another important feature of high transaction cost. So, in the first class also that we understood that there is this issue of transaction cost with real estate. For example, stamp duty, other such transactional costs which are there, and they add into the overall cost of real estate transactions, and they are a significant chunk of that. So, that is also one issue. Then there is another area which is regulatory framework. Now, that is something which has brought lot of transparency in this sector, specifically if we talk about retail real estate, which was earlier very opaque. Now, transparency is coming through government policy initiatives such as RERA, and that has compelled market participants to be more transparent in their workings of real estate. And then there is technological disruptions, which is also coming, that there are a lot of new portals such as housing.com, such type of real estate broking online firms, and there is lot of technology in forms of AI, blockchain, that is also impacting this particular field. So, that is also something which is very much there in real estate now. Then we come to participant ecosystem overview. So, the real estate market operates through a complex participant ecosystem. On the demand side, we have end users like first time home buyers, investors seeking rental income or capital appreciation, and corporate buyers purchasing for business purposes. So, different type of investors. Then on the supply side, it includes individual property owners, developers, constructing new projects. Then we have institution sellers like banks disposing of their foreclosed assets. Then we have facilitators such as real estate agents, brokers, and digital platforms, which we discussed earlier, like 9acre, Magic Bricks. So, there are different type of such online portals. Then we have their main function is basically like connecting buyers and sellers, bridging information gaps, all that. Then we have enablers including commercial banks, housing finance companies, NBFCs, and alternative lenders providing critical finance. Then we have regulators which are coming up with new and newer guidelines, regulations. So, we have RERA, we have bodies like RBI, SEBI, local authorities, which are enforcing the compliance and maintain the market stability. And then we have support services which are there for this, that is including legal firms, technical consultants, we have property management companies. So, they are ensuring operational efficiency. So, basically we can see that each participant action creates a ripple effect, influencing pricing, liquidity, and transaction efficiency across the ecosystem. Then we move on to primary versus secondary market dynamics. So, here let us distinguish between the primary and secondary market as they operate differently. In primary market, developers and builders sell new properties. These transaction features standardized pricing set by developers. We have staggered payment plans like linked to construction milestones, and we have future delivery timeline of 1 to 4 years. Then we also have RERA protection such as escrow accounts, which safeguard buyers, but risk like construction delays or quality issue sometimes persist. Then in contrast, the secondary market involves individual owners selling their existing properties. Pricing is negotiable and market driven with lump sum payment at registration and immediate possession. Then we have regulatory protection here, but it is very limited, and buyer must assess property condition risk. So, there are certain risks involved specifically with secondary market. Then for example, a new DLF project launch in Gurgaon with fixed pricing and RERA oversight is there, which is contrast. If we contrast it sharp, there is a clear contrast with resale apartment in the same locality where pricing is flexible, but due diligence is critical. Now, this example is very clear. That is, if a new project is coming, DLF will ensure certain standards. It's a regulated big player. But when it comes to in the same locality, once it is constructed and it has the units are now sold, now the RERA oversight, which was earlier there for the developer in the secondary market, when the flat owner is now trying to sell their flat to somebody else, then that regulatory oversight is not at the same level which was there for a primary market when the developer was selling their flat to the first homeowner. So, that kind of difference is clearly visible between the primary market and the secondary market. So, then we move to market efficiency and liquidity. So, we have seen earlier in the first presentation that we have 3 different basic categorization on the basis of geography in the terms of tier 1 cities, tier 2 cities and tier 3 cities, and we have seen that there is a clear difference in the prices of properties coming from these 3 different tiers of cities. The ticket size of properties is clearly, there is a big difference. So, in Mumbai and Delhi, property prices are far higher in comparison to say some very small city, and that difference is because of many reasons. So, talking about this, so in tier 1 cities like Mumbai, Delhi NCR, we have digital platforms such as housing.com, Magic Bricks providing robust information. It has enhanced the transparency and reduced the information asymmetry, which we discussed earlier, that is between the well informed developer or a retail investor. So, that information asymmetry is going down because of these digital platforms in such big cities. In tier 2 and tier 3 cities, we have limited data availability, which leads to reliance on local network, which can hinder efficiency. So, here the value of local network is much higher in tier 2 and tier 3 cities in comparison to tier 1 cities, and this is the reason that the local people, the people who are aware of that market is, their knowledge is very much important in these cities, and they play a very crucial role. Then coming to liquidity, so which is your basically time required to sell a property, that also varies. So, in Mumbai you will see that average we have around 4 to 8 months, Delhi NCR 6 to 10 months, Bangalore 3 to 6 months, and then you will see that there is a clear divergence from this in tier 2 cities, where it might take a lot more time in comparison, say for example 8 to 18 months, and so there is a clear time difference. Also liquidity issues are there. So, key factors driving liquidity will be your location proximity to business hubs or metro stations, connectivity via highways or public transport, that will be there, and then property type, whether it is a 2 BHK versus a luxury villa. Then pricing alignment, that is a factor with market rates and economic condition, that also influence the buyer sentiment. So, all these are creating factors which are related to market efficiency and liquidity. Then we have buyer categories and motivation. So, in that we can see that buyer dominates the residential market, accounting for 70 to 75% of transaction. Now, first time home buyers typically aged 25 to 35 with moderate income rely heavily on home loans with 80 to 90% loan to value ratios. They prefer 2 BHK or 3 BHK configuration in affordable location with strong connectivity, often leveraging PMAY subsidies to reduce cost. Their primary considerations are location, then of course affordability and connectivity to workplace or schools. Then we have upgrade buyers aged 35 to 50, who are basically experienced owners who sell existing properties to fund premium purchases, prioritize amenities like clubhouses or green spaces and developer reputations from brands like Godrej or Prestige. So, that becomes important for them. Then we have a third class, which is third category of buyers, which is your investment buyers, comprising 20 to 25% of the market. They include individual investors who are targeting rental income and capital appreciation. in high yield areas like growth corridors, typically holding 2 to 3 properties over 5 to 10-year horizon. Then we have NRI investors, which is again a very big class in India, that is the non-resident Indians. They are investing a lot. So, they invest for emotional ties to India and for portfolio diversification, and also they have to navigate FEMA compliance, which is foreign foreign individuals, they are regulated by FEMA. So, those compliances they have to navigate, and then also they have to navigate the currency fluctuation risk which is there. So, key decision factors for all buyers include location, affordability, connectivity, and developer track record. So, these are the things which are there, which we can see for buyers. Now, we will talk about sellers. So, sellers are diverse with distinct motivations. Individual property owners sell for various reasons. Some reasons can be like there are relocation sellers, which are doing that because they have some their jobs, and they are changing their jobs, they are getting transferred. They are time sensitive. These type of transactions are time sensitive. Then we have financial distress sellers seeking liquidity through aggressive pricing. They are selling because of some issues, some problems which are there in their life. Then we have upgrade sellers. They coordinate buying and selling to move to larger homes. We have discussed this before. And then we have investment exit sellers, which aims to optimize return by timing the market. Developers include here, there is another category of developers. So, developer basically include established national players like DLF, Godrej Properties, Prestige Group, known for large scale projects, whereas we have mid-tier regional developers with local expertise, and small developer classes also there, which are reliant on pre-sales to fund construction. But with the coming of RERA, we can clearly see that there is a shift towards more bigger players in this particular area of real estate. Then we have distress seller, such as bank selling foreclosed properties. So, people who have taken loan from bank, if they are not able to return it on time, or they are not able to return their loan, then in that case bank go for the selling of these properties which they had given as collateral. So, they go for distress selling of this. So, there is a full-fledged market for banks which is there. So, they do that. Then we have asset reconstruction companies. So, sometimes they are the ones who take the owners of these properties. So, when do they actually come in? So, they basically come in when there is an insolvency issue. So, managing that, they come in. They often price aggressively to clear inventory and impact market dynamic, because their idea is that they have purchased these properties, these units at very less prices, because already these were facing problems. Then they don't negotiate much, they go for whatever they are getting, and they sometimes cause ripple effect to the micro market in that particular area and bring prices down also. So, that is another category of sellers. Then we have real estate agents and brokers. So, real estate agents and brokers are critical facilitators. Individual agents comprising 80% of the market. They specialize in local areas, offering personalized insights into neighborhood and pricing trends. Then we have organized brokerages such as JLL, CBRE, Cushman and Wakefield, and they provide professional services for high value transactions. Then we have digital platforms, which we discussed earlier, like 99 acres, Magic Bricks, such type of digital platforms. They enhance accessibility, transparency. Their key functions include market information, provision for price discovery, transaction facilitation through negotiation, legal compliance support for documentation, and risk mitigation versus via due diligence. Then we have commission structures are standardized, which is 1 to 2% for residential transaction, 1 to 3% for commercial deals, and 1 month rent for the rental. So, there are different type of commissions also which are charged by these agents and brokers. Then moving on to another important, very important you can say regulation, that is RERA and its impact on the agents. So, RERA, that is Real Estate Regulatory Authority, which was enacted in 2017, has mandated the registration of agents. Now, we have mandatory state registration for agents. They have to have certain amount of education qualification, and annual compliance are now required for them. Agents must facilitate only RERA registered projects, maintain accurate transaction records, provide transparent project information, and handle customer grievances effectively. RERA's impact include professionalization of the industry. We can clearly see that it was not there before, but now we have standardization, and handle customer grievances, which is there. And then RERA also has led to consolidation of this area. Unqualified agents have exited because of the stringent rules. So, either they have to upgrade themselves and register under RERA, or they have option of exiting. And then accountability through direct regulation oversight and technological adaptation, with the digital platforms integrating RERA compliance data, enhancing trust and efficiency. So, there is a clear impact of RERA which we can see on agents. Then we have financial institution lenders. So, lenders are the financial backbone of real estate. Commercial banks hold around 60% of the housing finance market, with public sector banks like State Bank of India with a 30% market share, and private banks like HDFC Bank, ICICI Bank, and Axis Bank leading the way. Then we have housing finance companies such as HDFC Limited with a portfolio exceeding 6 lakh crore rupees. We have LIC Housing Finance, and we have PNB Housing Finance account for 25%. Then we have NBFCs like Bajaj Finserv, Mahindra Finance, and Tata Capital with 15%, offering flexible criteria and faster processing. And then we have interest rate environment influenced by the RBI's 6% repo rate as of April 2025. This keeps on fluctuating. So, this sees home loan rates ranging from 8.5 to 10.5%, impacting the affordability and borrowing decisions. So, that is there. Then we have lending products and the criteria for them. So, in this, lending products are tailored to diverse needs. We have home loans which are offered up to 80% LTV ratios with tenure of 5 to 30 years. We have construction loan featuring stage-wise disbursement alignment aligned with the project progress. Then we have plot loans which have lower 60 to 70% LTV ratios and higher rates. Then we have commercial property loan range from 9 to 14% with 60 to 75% LTV. Then underwriting criteria include income verification for salaried or business income, minimum CIBIL score of 650 to 700, property valuation for legal and technical compliance, and debt to income ratios capped to 50 to 60%. Then we also have government schemes like PMAY and CLSS, which provide interest subsidies, making home ownership more accessible, particularly for first time buyers. Then we come to regulatory framework, RERA. Now, we have talked about RERA a lot. So, we know that it was introduced in 2017. It protects home buyers' interest and rights. It ensures timely project completion, bring transparency in project information, and establish effective grievance redressal. Here, important is this the implementation requirements. So, project registration is mandatory for projects which have greater than 8 units. Then we have agent registration, state wise licensing requirements are there. So, there are different state RERAs. Then we have escrow accounts, that is 70% of the project funds. Segregation, so a separate fund segregation has to be there, so that the buyer's money is not wrongly used, it is used for the project itself. And then we have information disclosure. So, comprehensive project details have to be given to the buyers, full disclosures have to be maintained, and we can see that it has driven 90% improvement in the on time delivery of the project and significantly boosted the buyer confidence, and the trust has come back in this market, and people are now much more confident of the dealings in real estate in comparison to a few years back before the RERA. So, coming to other regulations which are there. So, beyond RERA, RBI, that is Reserve Bank of India, it regulates monetary policy impacting the lending rates. In the first session, we very briefly touched that if there is a small difference or small change in interest rate, it impacts the EMI of a particular housing loan drastically. So, that is there. So, that is being regulated by RBI. Then we have housing finance companies and NRI investments under FEMA, which is there. Then we have authorities, bodies setting loan to value norms, that is how much loan in percentage terms you can give to the overall value. And then we have priority sector lending guidelines which are there from RBI. Then we have Security and Exchange Board, SEBI, which governs indirect real estate investment asset classes such as REIT and real estate mutual funds, and ensure the investor protection through that. Then we have state and local authorities, which include town planning department and municipal corporation. They manage zoning, building permission, utility connections and environmental clearances, shaping the urban development and market operations. Then we have REITs in Indian market. We also started discussing it in the first class, that REITs in India, new asset class coming up. We have different REITs which are listed. 4 REITs, mainline REITs have been listed, and 1 SM REIT is listed. Here you can see the first 3 REIT which were listed in India, their information is given. One of them, that is one recently listed mainline REIT, and then there is another one which is SME REIT, that I have not included, but here you can see the first 3, and they are Embassy Office Park. You can see that it is now of 32,000 crore market cap. Then we have Brookfield India Real Estate, which is now 12,000 crore market cap. So, they are picking up, and they are big REITs. In terms of the size, you can compare them to the topmost market cap REITs in Asia. So, Indian REITs may be few in number, but the size are very big when we compare them to the REITs in other parts of Asia. Then some important characteristics are there. There is a 90% income, minimum 90% income distribution is there. They are professionally managed. There is a liquidity which is not there in the direct real estate investment, and then we have a good dividend yield of around 5 to 7%. Plus we have price appreciation of the units of REIT. So, overall somewhere around 7 to 8% you can expect from this asset class. And the market impact, it has democratized this institutional real estate investment access, which was only there for the commercial real estate sector was not there much much easily available to retail investor. Now through this REIT indirect, they can also, retail investor can also participate in such big projects, commercial projects, where it was not possible for the retail investor to participate earlier. So REIT has given us that option. Then we have other key participants. So we have real estate developers, we have national players. We have discussed that now market is shifting more towards these national players, DLF, Godrej Properties, such big companies. Then we have regional specialists, regional players, regional developers, and we can also see that we have institutional investors in this particular market now coming up at a rapid pace in India also. So with the coming up with newer and more transparent making regulations by RBI, SEBI, we now have investments coming from such institutional investors such as Blackstone, Brookfield, Capital Land. All they are also coming up and investing in Indian real estate market. Then we have pension funds which are coming in. We have sovereign wealth funds such as GIC Singapore Investments. They are also now participating in India. So these are different key participants which we can see. Then we have property management companies, we have legal services, because we have already seen that the big part of the real estate is the transaction cost. So that is also there. And then we have technological providers which are enabling all this, and they are prop tech platforms, and they are providing the digital solutions. Then we come to market participant interaction. So we have discussed this, that there is an information flow dynamic. Developers have superior market intelligence, buyer face information asymmetry challenges. Generally, when we are talking about buyers, we are talking about retail buyers, retail investors, or the first time house owners. So their information in comparison to developer is much less. So that information flow of real estate market is not is completely definitely biased towards the developers. They are much more informed about the different policies which are being planned by government. They are also privy to corporate activities which might happen in a particular area, road extension and all that. So they are also completely aware of all this information, and there is a clearly edge for developers in this area in comparison to buyers, which are sometimes first time and the only time they are buying their residences. Then we have agents which basically working as a bridge in this information gap. So they are creating a bridge between developers and buyers. And then we have digital platforms which are improving the transparency in this area. Then transaction facilitation. So we have coordinated process involving multiple participants here. We have risk sharing across ecosystem participants. We have streamlining of interactions, and then of course overall on this is a regulatory oversight ensuring the compliance. So all the different people or different categories of stakeholders which are there in this particular area of business, you can see that they are somehow sharing this risk, and they are connected to each other. And also touching upon this is the financial ecosystem which is there. So we have lender, developer, project financing relationship. We have lender buyer, so mortgage is there. So banks and buyer relationship is there, and then escrow management under RERA regulation, that is also there. So there are different type of you can say systems present inside this overall real estate market. Then another important feature is market cycles, and on the basis of that participant behavior. So market cycle significantly influences the participant behavior. In expansionary phases, developers aggressively acquire land and launch multiple projects. Buyers make quick investment driven decisions. Lender relax underwriting standards, and investor use high leverage with optimistic projections. In recessionary phase, now this is all happening in expansionary phase. Developer aggressively acquiring land, buyer making quick investment decisions, lender relaxing the underwriting standards. Now, in recessionary phase, developers focus on inventory clearance with attractive schemes. Buyer gain negotiation power, so buyer have upper hand in those days when there is a recessionary phase, and lenders tighten norms with conservative valuation, and investors prioritize liquidity over growth. So, for example, in 2005-2008 boom, we saw rapid development, while 2008 to 2012 we saw a correction in the real estate market. You can take example of Mumbai, where you can clearly see that this happened. So, this kind of situations happen, that there is a market cycle, and accordingly there is a participant behavior also. Then we come to external factors which impact this market. So, macroeconomic factor. Now, macroeconomic factor includes RBI's repo rate, which influence lending rates, right, which influence is there influencing the lending rate, and because of this lending rate we can see that a small change in that leads to big change in EMIs. We have GDP growth driving demand, we have inflation impacting the construction cost, and employment fueling housing needs. Then we have government policies like GST enhancing the pricing transparency, while demonetization in 2016 caused short term disruption. Then we have infrastructure development such as metro lines, highways and airports boost property values in connected areas. Then we have technology disruptions, which include digital platforms, virtual tours, blockchain for secure transaction, and AI for analytics. And we have improved transparency enabled by the remote transaction, reshaping of the market access. So, all this is happening. So, these are the external factors which are impacting this market. Now, let us take one case study to understand this. Let us examine the Mumbai Bandra Kurla complex, a 370-acre commercial district valued at over 1.5 lakh crore rupees, planned in 1970s and developed significantly in the 2000s. BKC's success stems from MMRDA's infrastructure first approach. So, including roads and metro connectivity, it is there. Then quality developers like Godrej, Phoenix Mills, Oberoi and Prestige delivered international standard projects. Then strong corporate demand from financial services supported by major banks and property management firms like JLN and CBRE drove growth. And then the public-private partnership model, which ensured coordinated efforts, making BKC a benchmark for participant collaboration. And so, basically here you can see the different participants which are there in a particular real estate system, and clearly you can see that there is buyers, there are developers, there are regulators, there is a government initiatives. So, all this is basically playing out a crucial role in any real estate venture. So, this is just one example, but you can see that this system involves all these stakeholders, and they have a active role in this. Then we come to technology impact on the market structure. So, technology is revolutionizing real estate. Online platforms we have discussed multiple times, like 99 acres, Magic Breaks, and there are multiple others also coming up these days. They expand the market reach, they are basically connecting buyers and sellers pan India. Virtual tours which are there, that enable remote property viewing, reducing physical visits. This is a specific features they are now offering, which was something which is something unique, and which is making easier for buyers to actually look at property without going there. Then we have digital documentation, so streamlining approvals and agreements with AI powered analytics providing personalized property recommendation. So, these advancements reduce brokers dependency, enhance service efficiency and improve market transparency, and that is the key to all this. That is, all these different online platforms are increasing the market transparency. Now, market is much more transparent, it is much more clear, and because of this transparency, buyers have a much more confidence on what they are purchasing, in what transaction they are going into. So, this kind of advantages we are getting from these new online platforms. Then we have risk factors and market stability. So, real estate faces systematic risk including financial system volatility like credit cycles or liquidity crisis. We have regulatory changes disrupting operations, market specific risk like oversupply or demand shifts, and external risks such as global economic downturn or natural disaster. We have mitigation strategies also. So, because we have just discussed different type of risk, financial system risk, policy regulation risk, market specific risk, external risk, but there is a risk mitigation also. You can control the risk also. Now, what is that? So, that includes diversification across geographies, property types, different type of properties you can invest, and also this property types, and you can also go with different understanding of the decision makings, how the process of investing is. You should go deeply into that. So, that is also something which can help you in mitigating the risk. Then, so basically we have also like lenders can go for conservative underwriting risk assessment, which they can do properly. Investors, of course, they can go for portfolio diversification, and developer they can go for better regulatory compliance. Sometimes they do it by mistake, so they should not, and they should have proper regulatory compliance. So, they should have a proper eye on what are the new regulations. So, these can minimize the risk. Then we have future market evolution. So, the market is poised for significant evolution. REITs are projected to reach a $50 billion market by 2030, expanding institutional investment. Then we have digital transactions which will achieve 80% adoption driven by platforms and blockchain. Then we have uniform RERA implementation will enhance the transparency across states. Then sustainability, so including green building norms and ESG investments will become a valuable driver in this area. Then market consolidation will see increased merger and acquisitions. Integrated service platforms will bring stricter professional standards, and national developers expanding into tier 2 and tier 3 cities, creating new investment opportunities and improving market efficiency. Now, all these are basically future market possibilities. These are some projections which we can make on the basis of what is happening currently. It may not happen or it may happen, there may be some changes, but that is the dynamics of the market. Any investment market, you will see that the future possibilities are immense, but you can always project on the basis of the current guidelines which are there, the thrust of the government, the policy makers, and how the overall things are moving in a particular direction. So, trends you can project through that, and trends are clearly pointing towards all this, that there is a expanding real estate market in India. The size will keep on growing, sustainability will become more and more important, and the transparency will improve as we go further in this particular compliance of rules such as RERA. Improvement of that, more stringent application of that will bring lot more transparency in this particular business also. So, that is your future market, how it will evolve. Then moving on to the key takeaways. So, we have seen that real estate market involves complex participant ecosystems. There are multiple players here, lot of layered interactions. So, that is important takeaway, that multiple players, multiple rules, multiple type of industries are connected to real estate. Then information asymmetry, that we have discussed, that clear information asymmetry is there between the buyers and developers, something which is closing in because of the efforts of the online brokers, online platforms, the RERA certified brokers. So, all this is bringing, it's creating a bridge between buyers and developers, lowering the difference in the information availability with both of them. Then we have regulatory framework significantly impacts the market operations. We have seen that how RERA is impacting this business, has transformed this business by bringing more transparency. And then technology is transforming traditional market structures. So, technology is also making a lot of improvements in this area. Then we have participant analysis. So, each participant has distinct motivation and strategy. So, we have seen that how lenders have to strategize, how developers have to strategize, and how buyers have to plan, and there are different ways in which each participant can make their own strategy. Then interaction between participants drive market dynamics. How they are interacting, that is also playing a crucial role in market dynamics. And then professional services, they are becoming increasingly important. Then we have institutional participation, improving the market maturity. So, market is getting matured, new and new institutions are now coming both from foreign and from India, and participating in this dynamic market of real estate in India. Government is also creating grounds for them to come. They are improving the regulations, they are creating regulations, like we have seen the example of REIT. So, that is there, participants are increasing and have a distinct analysis for each participant. And then investment implications are also there because of all this. So, understanding the participant behavior aids in investment decisions. Market cycle require different strategies for different participants, boom times, bust times. We have seen the cycles are different. So, different times require different strategies. And then due diligence across all participant interaction is essential. Then professional advisory is also there, which is valuable in complex market structure. So, if you are getting this professional advisory, it is very valuable in real estate, and the main point is that it should be coming from a trustworthy source. So, that is why SEBI is also encouraging the investor education. So, that is an important point here, that professional advisory is also something which can be used by buyers. Then moving on to the market structure knowledge. So, for investors, applying this knowledge by evaluating developer track record for reliability, agent credibility for trust, and lender terms for affordability. Then we have time investment based on market cycles, buy during correction for value, sell during boom for profit. Asset risk across participant interaction, such as developer delay or lender restriction, and leverage relationship with agents or financiers for optimal outcomes. For professionals, identify career opportunity in agency, finance or PropTech, and then build value proposition addressing participant needs, such as transparency for buyers or financing for developers. Develop strategic networks across the ecosystem and stay compliant with evolving regulations. This knowledge enhances the investment framework from our previous sessions, and thus provide operational context for the strategic decisions. Then some questions for further study. So, these are important questions, and I hope that after this session you will definitely think about them, research them on your own. For example, how do participant interact different, how do participant interaction differ across Indian cities? So, we have seen that we have certain price ranges we have given, certain return ranges we have given. What are exactly there for your own city? So, that you can find out. Now, what role does technology play in reducing the information asymmetry? Now, we have discussed that online portals are helping in this regard, but what other technologies are coming up, such for example, AI, blockchain, we have discussed at a very peripheral level, but you can go deeply into that and understand how they can help buyers in reducing information asymmetry. Then, how effective has RERA been in protecting the consumer interest? So, there has been a lot of talk about the transparency which has been there now in real estate due to RERA, but what is the level of that transparency? So, that can also be something you can work on, find out. Then, investment strategy, how should market cycle influence participant selection? So, that is something which can be studied. We have seen boom and bust period, how they are affecting. Deeply you can understand that. Then, what factors determine the optimal participant mix for real estate investment? So, that is something which can also be studied. Then, how do international best practice apply to Indian market structure? Now, we have discussed this course in terms of, we are discussing this course in terms of Indian context. We are taking example from India, but real estate market is present throughout the world. Principles which we are learning are applicable to any other geography. Now, how they are being played out in developed countries, how they are being played out in other Asian markets. So, you can take case studies from there, you can go through that, and you can then compare it with Indian situation and develop newer insights into this area. Then, policy implications. So, what regulatory changes would improve market efficiency? Something policy makers are always looking out for newer and better options, suggestions. They are always welcoming suggestions. So, if you can find out how new policy or policy directions can improve real estate, so you can do that. So, that is there. Then, how can technology adoption be accelerated across all participants? Technology adoption in other areas apart from what we are seeing right now, you can study that. And what measure would enhance market transparency further? So, more and more transparent market will bring more people into this area, this business, and confidence of investors would also increase. Now, these are some additional resources which you can go through, you can see, and you will get to know more about this area. So, RERA portals, different state RERAs are there. For your specific state, you can go and visit the website, understand what are the new projects coming, what disclosures they are making. Then, RBI guidelines, keep yourself updated with that. SEBI REIT regulations, you can read the REIT regulations. Lot of amendments have taken place. Then reports are coming from these big real estate international brokers. So, you can read those reports. They provide insights into Indian market, into international markets. We have CREDAI reports, we have PropTech analytics. So, all these reports, all these documentations which are available on internet, you can go and read that. It will help you knowledge in this particular area. And of course, there are academic references, books which you can go through and understand about the real estate principles. Then concluding points. So, we have understood that, seen that the complex participant networks driving Indian real estate markets. Key insight include dominance of participant behavior over pure economic factor, transformative impact of regulation like RERA, disruptive role of technology enhancing transparency and efficiency, and the critical importance of information advantages for investment success. These insights provide the operational context for strategic decision making. In our upcoming session, we will build on these foundations and we will study them more through different angles and understand all this. Understand who does what in real estate market equips you to master how to value and when to invest effectively. So, with this I come to the end of this session.